Welcome to this very short video from Retirement Crusaders about year-end tax breaks you got to be sure and take before December 31st. Now, the first one is sell stocks and take a loss. Now, there's some people that have a strange way of thinking about this. They think if they bought a stock for $10,000 and if it's now worth $5,000, they haven't lost anything until they sell it. That's crazy thinking. If you go to a bank and you say, hey, I've got this stock as collateral for a loan, I bought it for $10,000, the banker's going to say, what's it worth now? Oh, $5,000. He'll say, good, that's $5,000 of collateral. So whether you sell the stock or not, you've lost the money. Now, the reason you want to sell the stock is because if you take the loss, IRS will share some of the loss with you. Each year, you can, of course, deduct any of your losses against your gains, and in addition, another $3,000 you can take in losses to use to shelter $3,000 of interest or earnings, any other type of ordinary income. So to not do this each year is simply throwing away money. For example, let's say your tax bracket's 25%. So the $3,000 that you can deduct times 25% is $750. So each year you're taking $750 and just throwing it down the drain. Look, that's 3 extra nights in Hawaii on your vacation. So take advantage of this each year, please, and understand that you've lost money on a stock if it's gone down, whether you sell it or not. Now remember, you can't buy that same stock back for 31 days. So once you sell it, you've got to wait 31 days. If you're worried that it might go up in the meantime, you could buy a mutual fund or an exchange traded fund in the same industry, or you could buy another stock in the same industry. For example, if you sell Bank of America for a loss, you could buy a Wells Fargo 5 minutes later and hold that for the next 31 days and then sell it and buy your Bank of America shares again. Because if you buy back the same stock within 31 days after taking a loss, IRS says, no, you can't actually take the loss in your tax return. Okay, next issue. Convert some of your money that's in a regular IRA to a Roth IRA every year if the following situation applies to you. Now, this is a table of tax brackets for 2022. Let's take this example of a married couple filing jointly, and if they're in this range between $20,550 and $83,550, let's say their taxable income is right here at, say, $70,000. Well, they have between $70,000 and $83,550. There's another $13,550. If they added to their income, it would still be taxed at 12%. So this is a good thing. You want to take advantage of low tax brackets. So if you notice that you've got some money left in a low tax bracket, convert some money from a regular IRA to a Roth IRA, and then you would convert, in this case, in our example, you would convert $13,550, so it'll bring you to the top of that tax bracket. So then you've now caused yourself to pay tax on that $13,550 that you convert from your traditional IRA to your Roth IRA, but it's only at 12%. And you want to take advantage of that because you've got to look at your future years. And in future years, if you start taking large IRA distributions, say after age 72, the problem you'll have is you may be paying tax at 22% or maybe 24%. So take advantage of your low tax brackets while you can. So you may want to convert some money from a traditional IRA to a Roth IRA a little bit each year to make use of your lower tax brackets. Number 3, always, if you're going to give money to charity, do it from your IRA. Why? Well, it's a real simple idea. For each dollar of IRA money that you leave to your children, they're not going to get $1. If they're in the 30% tax bracket, they're going to get 70 cents because they've got to pay 30 cents to IRS. So if you leave $1, if you're going to give money to charity anyway, do it from your IRA, because that way $1 from your IRA is $1 of value to the charity because the charity doesn't pay any tax. So there's a thing you can do each year. It's called a qualified charitable donation. You have to be age 70 and a half when you start this. You can transfer up to $100,000 a year from your IRA directly to a charity. Now, you can't have the money come to you and then you give it to the charity. There's a form that your IRA custodian will have, wherever your IRA is at. There's a form that they have. You tell them which charity you want to give to. They will transfer the money. Also, if you're of the age where you have to start taking required mandatory distributions, that charitable transfer will count toward those mandatory distributions. So let's say you're 73 years old, you've got to take a required mandatory distribution for the year, and it's $10,000. If you do a qualified charitable donation, directly transferring $10,000 from your IRA to a charity, that will satisfy your required minimum distribution for the year. So you can take advantage of this every year, again, up to $100,000 a year, and it's a great way to give to charity because you'd rather give this money to charity and leave your already taxed money to your heirs. Thanks for watching. Hopefully this helps you save some money at year end before December 31st on your taxes. See you next time on Retirement Crusaders.